Every day, trillions of dollars move through the global financial system. Banks, investors, and governments constantly move money across global markets. At the center of this system stands the United States dollar. Because the dollar powers global finance, decisions in America affect markets everywhere. But when the United States creates new money, the impact spreads across the entire world.
To understand this process, we must first look at how money is created.
In the United States, money creation is closely linked to the banking system.
At the center of that system stands the Federal Reserve.
The Federal Reserve controls liquidity in the world's largest financial system.
During economic crises, the Fed can rapidly expand the supply of money.
In modern economies, most money does not exist as physical cash.
Instead, money exists mostly as digital balances inside the banking system.
This means new money can be created electronically.
During crises, central banks create new reserves to stabilize markets.
The Federal Reserve does this by purchasing financial assets.
One of the main tools used by the Federal Reserve is quantitative easing.
Through this policy, the Fed creates new money electronically. The newly created money is used to purchase government bonds. When the Fed buys these assets, money flows into the banking system. Banks suddenly hold more reserves and liquidity increases across markets. With more reserves available, banks gain greater capacity to expand lending. As lending expands, the total amount of money in the economy begins to grow.
But much of this new liquidity flows first into financial markets.
Investors begin purchasing stocks, bonds, and other financial assets.
Into bring interest when control on SAGs. As demand for assets rises, financial markets often move higher.
Lower interest rates make borrowing cheaper across the financial system. Cheap money encourages investors to search for higher returns. Large investment funds begin reallocating capital across different markets.
Some of this capital begins to flow beyond the United States.
Global investors move money wherever opportunities appear strongest. When liquidity increases, global capital begins moving more rapidly.
Investment funds search for higher yields outside the United States and make
Emerging markets often receive large inflows of international capital.
These flows can rapidly lift stock markets and asset prices.
But global capital can move just as quickly in the opposite direction.
Global capital flows respond quickly to changes in interest rates.
When U.S. interest rates rise, money often begins returning to American markets.
Higher yields make U.S. assets more attractive to global investors.
Investors shift capital toward safer assets like U.S. Treasury bonds.
As money flows back to the United States, global markets often face pressure. Because the dollar dominates global finance, U.S. monetary policy reaches far beyond its borders. Changes in U.S. liquidity conditions ripple across international markets.
Banks, funds, and institutions constantly adjust their positions.
These shifts can trigger rapid movements across global markets. Even distant economies can feel the effects of U.S. monetary expansion.
Look at that spike.
It's breaking resistance. We are hitting the targets.
Stocks, bonds, and real estate can surge during periods of abundant money.
Some economists warn that excessive liquidity may inflate financial bubbles.
When asset bubbles grow too large, financial stability can be threatened.
History shows that rapid financial expansion can sometimes end in crisis.
As more money enters the system, inflation can become a growing concern.
Higher interest rates gradually reduce the flow of easy money.
Central banks must carefully balance growth and price stability.
If inflation rises too quickly, central banks may tighten monetary policy.
Raising interest rates can slow lending and reduce excess liquidity. Higher interest rates gradually reduce the flow of easy money.
Liquidity. As borrowing becomes more expensive, economic activity can begin to slow.
The cycle of liquidity expansion and tightening continues to shape global finance.
Global capital flows begin shifting once again.
The cycle of liquidity expansion and tightening continues to shape global finance.
When liquidity expands in America, financial conditions change across the planet.
Markets from Asia to Europe quickly react to shifts in U.S. policy.
International investors constantly monitor signals from the Federal Reserve.
Because the flow of dollars influences the stability of the global economy.
When the United States creates money, the effects travel far beyond its borders.
Liquidity created in America can reshape markets around the world.
From stocks to currencies, financial markets respond to shifts in dollar supply. Even economies far from the United States feel these monetary waves.
Because the global financial system remains deeply connected to the dollar.
In today's world, money moves through a deeply interconnected financial system.
And at the center of that system stands the United States dollar.
When America expands the supply of dollars, liquidity spreads worldwide.
Those financial waves can lift markets or trigger instability.
Because when the United States creates money, the entire global economy feels the impact.